look at the flip side. Which businesses weren't doing well 7 years ago that are doing particularly well now?
Well, again, it's just so interesting because we have very short memories. We forget our perception of whether a business is a good one or not is actually often based on how the share price has performed rather than the fundamental business itself. The businesses which were doing poorly then and which we were invested in at the time were businesses like Tiger Brands. There were businesses like Richemont, businesses which have subsequently, given that they were cheap then, have performed incredibly well, which everyone at the moment is still thinking, you know, you should hang on to them. Maybe they'll continue to produce those returns. But one fundamental thing has changed. Then they were cheap, now sadly, they are expensive.
So I suppose the million-dollar question, and I'm sure you get this all the time, is how do you identify which of those businesses are worth investing in and which are going to slump?
Yeah, well, we do it a slightly different way. At ReCM, we are value investors. And again, what it's about is not trying to sort of predict what the share price is doing. It's actually simply using the share price as an opportunity to buy or sell relative to what you think a business is worth. So the share price in itself is not enough information. You need to know what is a business worth and then look at the difference between those two. So how do we determine then what a business is worth? Because I think that's what it ultimately comes down to. Now, a lot of analysts go out there and they try to project what businesses will do in the next year, 2 years, based on how they've done, based on the management team. Now, I can tell you that management themselves can't tell you exactly what revenues, margins, how that business is going to do a year on. So what chance do you have as an analyst sitting from the outside, analyzing this, seeing the tip of the iceberg, saying precisely what that business is going to do? So we steer away from that forecasting side of things. What we do is we say, how has this business performed in similar cycles historically? What is sort of the sustainable level of sales, level of margins, the sort of profits that they sort of can earn consistently sort of through the cycle? So again, not the best of times, not the worst of times, but kind of on average. And we plug those numbers into our formula, and that tells us what the business is worth on average through the cycle. If you had a particularly low point in the cycle, then what will often tell you is that the share price is significantly lower than that, and we're looking for about a 30% difference. Unfortunately, even the best businesses, if you buy them at a high price when they are reflecting optimism and overly optimistic expectations of how they will do going forward, they might still do well, but if they don't do as well as expected, the share price is too high. Then we steer away from those as soon as that business is trading anywhere north of what we calculated to be worth.
Is that the advice then that you would give to a first-time investor who approaches you?
I think, you know, a first-time investor who approaches us, I think my best advice to give to any investor is to pick asset managers, pick funds, pick asset managers that you trust. Make sure you understand how they invest, that it makes sense to you. Don't just pick a fund that's performing well, because that might be luck rather than skill, you don't know. And stick with it. And when I say stick with it, I'm not talking about a year or 2 years. I'm talking about 5 years and more. Because someone can do well for a short period of time, but it's really all about managing money through market cycles. When markets are going up, when they're going down, over that full period of time, producing a good return above inflation. So pick managers you trust because you understand what they do, because it makes sense to you, and stick with them.
Now, we're nearing the end of 2014, and it's certainly been a very interesting year for us economically. You touched on our prolonged strikes, and even now our Deputy President has taken control of many state-owned enterprises that have been floundering. Are you optimistic about South African markets going into 2015?
We are. In fact, we have actually increased our number of South African investments in our portfolio over the last year rather than decreased. I think, again, it's not about what will happen in terms of whether it's good or bad. It's about what the market expects, and is the market being overly pessimistic? And I think right now, everyone is overly pessimistic about South Africa Incorporated. Now, the businesses, if you look at the shares that have done well, they're businesses that have more of a global sort of theme about them. They're sort of ex-South Africa. You know, it's Naspers and it's Richemont and it's SAB. So they're businesses which have a lot of exposure outside of South Africa. The share price South Africa, we believe, are overly pessimistic. In other words, things won't turn out as bad as the market expects. And that's what you've got to have. You've got to basically buy businesses which are priced so low that even if things level out, even if things stabilize, you're going to have huge upside. But because the prices are so low today, your downside is limited. And that's very different to buying a business where everybody thinks that it's just going to continue to shoot the lights out. So you're paying a very high price for it today. But even if it does well, but disappoints relative to the market's expectations, you're going to have substantial losses. Even if that underlying business continues to do well, as an investor buying that share at a very high price, with all of those high expectations, that business priced for perfection, anything less than perfection is going to result in a permanent capital loss.